On April 2nd, 2025, one announcement wiped out $6.6 trillion in global stock market value in 2 days. It was the single worst two-day loss in United States stock market history. The announcement was a tariff policy. And what happened next, over the following 12 months, is one of the most complicated stories in modern financial market history. This video is not about politics. It is about what the data actually shows. Which markets got hit, which markets recovered, which markets quietly outperformed while everyone was watching the S&P 500, and what the events of the last 2 weeks mean for investors right now. One global market on this list has outperformed the S&P 500 by more than 20 percentage points since Trump's second term began, and it is not China. I will tell you exactly which one that is at the end. Now, let us get into the data. Donald Trump began his second term on January 20th, 2025. Within weeks, the administration imposed 25% tariffs on goods from Canada and Mexico, citing immigration and fentanyl concerns. Then, on April 2nd, 2025, a date the administration called Liberation Day, Trump announced a 10% blanket tariff on all U.S. imports, with higher country-specific rates for dozens of trading partners. China faced an effective rate that reached 54% on many categories, and in some high-sensitivity sectors, 145%. The S&P 500 experienced one of its worst two-day declines in history. The Nasdaq Composite fared worse. Within days, $6.6 trillion in market value had evaporated globally. The only thing that prevented the U.S. indexes from entering bear market territory, defined as a 20% decline from a peak, was the administration's partial reversal of the tariffs just days after the announcement. Markets recovered, but the dynamic had shifted. According to the Tax Foundation, the average effective tariff rate on U.S. imports reached 7.7% in 2025, the highest level since 1947. That is not a small number. For context, before Trump's second term began, the effective rate was around 2.5%. The tariffs amounted to a tax increase of approximately $1,000 per U.S. household in 2025, per the Tax Foundation's estimate. In 2026, that burden is projected at $400 to $600 per household under the remaining tariff regime, even after recent legal developments. The U.S. market. The S&P 500 spent much of 2025 oscillating between tariff shock and recovery. By late 2025, U.S. equities were near record highs, with the S&P 500 hitting all-time records in mid-2025, supported by strong Q3 GDP growth of 4.3% and continued AI investment momentum. But the year ended on a weaker note. U.S. GDP in Q4 2025 grew at just 1.4% annualized, less than half the economists' forecast of 2.5% and far below Q3's pace. Motley Fool noted in February 2026 that the S&P 500's cyclically adjusted price-to-earnings ratio, the CAPE ratio, had reached 40. That level has been seen only once before in history, at the peak of the dot-com bubble. Global markets. The surprise rotation. Here is the data that does not get enough attention. While U.S. markets wobbled, global markets began to quietly outperform. The iShares MSCI ACWI ex-US ETF, which tracks 22 developed markets and 24 emerging markets outside the United States, significantly outperformed the S&P 500 in the first months of 2026. The S&P 500 trailed global markets by its widest margin since 1995 in early 2026, according to Motley Fool. Europe diverged from initial expectations. Germany's DAX continued to reflect resilience despite the global tariff pressure. Other countries actively capitalized on U.S. trade friction. The UK and India completed a historic free trade agreement in May 2025. Canada and ASEAN nations began pursuing their own trade deal. China signed zero-tariff access agreements with 53 African countries and deepened ASEAN ties. A world realigning around trade corridors that do not include the U.S. That is not a future scenario. It is what was already happening through 2025. On February 20th, 2026, the United States Supreme Court ruled 6-3 in Learning Resources, Inc. versus Trump. The court held that the International Emergency Economic Powers Act, IEEPA, does not grant the president the constitutional authority to impose tariffs. The ruling was immediate and significant. It invalidated the administration's sweeping country-level reciprocal tariffs and the fentanyl-related levies on Canada and Mexico, which together had accounted for roughly half of all U.S. customs duties since early 2025. The Penn-Wharton budget model estimated that cumulative IEEPA tariff collections had reached approximately $165 billion through January 2026, with potential refund exposure of up to $175 billion. Walmart, Target, Amazon, and other large importers stand to receive substantial refunds, but the court did not address refund mechanics, leaving the matter to further proceedings. On the day of the ruling, the S&P 500 rose 0.69%. The Nasdaq gained 0.9%. The Dow added 230 points. But here is the critical nuance. The tariffs did not disappear. Within 96 hours of the ruling, the administration invoked Section 122 of the Trade Act of 1974 and announced a new 10% global tariff, initially raised to 15% before settling at 10%, under different legal authority. Section 122 tariffs are capped at 15% and expire automatically after 150 days, setting a hard deadline of July 24, 2026, unless Congress votes to extend them. According to IG International, even with the IEEPA tariffs gone, the average effective U.S. tariff rate under Section 122 would still be the highest since 1947, excluding 2025. The era of trade by tweet is constrained, but it is not over. Sectors and markets under pressure. Technology multinationals with global supply chains, particularly Apple, absorbed the heaviest direct tariff costs. Apple reported between $800 million and $1.1 billion per quarter in tariff costs throughout 2025. Retail importers like Walmart flagged a tariff cliff in their February 2026 quarterly report, warning that inventory buffers built up in 2025 were exhausted and general merchandise prices had jumped 3% immediately. Goldman Sachs economists estimated U.S. consumers would absorb 55 to 70% of all tariff costs, with businesses taking on another 22%. Yale Budget Lab projects consumer pricing up 1.2% in 2026 from tariffs alone. Sectors and markets benefiting. Small-cap domestic U.S. companies that do not rely on foreign manufacturing, saw a meaningful rotation in their favor. As of March 2, 2026, the Russell 2000 had outperformed the Nasdaq by nearly 9% over the prior 30 days, as investors shifted away from multinational tech giants toward domestic-focused businesses. Nearshoring hubs, including Mexico and Vietnam, continued to attract manufacturing investment. Even with tariffs applied, production in those regions remained more cost-effective than a rapid U.S. reshoring push. Canada's TSX hit an all-time high of 33,998 on February 23, 2026, up more than 6% year-to-date, aided by the Supreme Court ruling and strong performances in financials, technology, and mining. The honest picture right now is this: policy uncertainty is not gone. It has changed shape. The IEEPA tool is off the table, but Section 232 tariffs on steel, aluminum, autos, and semiconductors remain in place. Section 122 tariffs expire in July 2026 unless Congress acts. A tariff landscape that was defined by executive orders is now moving toward a more process-driven, legally constrained, but still elevated trade environment. Charles Schwab noted that global growth is expected to re-accelerate in 2026 if trade uncertainty recedes. But that condition has not been fully met. Markets are forward-looking. They are already pricing in scenarios. The investors who tend to do worst in periods like this are the ones who react to every headline rather than positioning for what the data over time is actually showing. I told you at the start, One global market has outperformed the S&P 500 by more than 20 percentage points since Trump's second term began. And it is not China. That market is Canada's TSX. In 2024, the TSX gained nearly 22%. In 2025, it posted a total return of 31%, its best in over 15 years. And in the first 2 months of 2026, it hit an all-time record high. The TSX benefited from commodity strength, a rate cut cycle from the Bank of Canada, and, most recently, the tailwind from the Supreme Court ruling that stripped the administration's most aggressive tariff tool. The US and Canada are deeply interconnected economies. What disrupted the US sent investors looking for the next best-positioned market, and the data says it was sitting next door the whole time. Here is the 5-point summary. 1. The April 2025 Liberation Day. Tariff announcement triggered the worst 2-day loss in US stock market history. $6.6 trillion wiped in 48 hours. 2. The average effective U.S. tariff rate hit 7.7% in 2025, the highest since 1947. 3. The Supreme Court struck down IEEPA tariffs on February 20th, 2026. But the administration's Section 122 replacement tariffs are still in place and expire July 24th, 2026. 4. Global markets, particularly the TSX, European indices, and select emerging markets, have outperformed U.S. markets meaningfully since early 2026, with the divergence at its widest since 1995. Within the U.S. market, the rotation is domestic, small-cap stocks outperforming multinationals, domestic revenue over global supply chains. Question for the comments. Do you think the tariff situation resolves before the July 24th deadline? Or does this become a congressional battle that drags into the second half of 2026? Drop your red below and subscribe if this kind of data-forward analysis is what you are looking for.